What was the first internet investment you ever made?
First internet investment I ever made? Probably a company that was later indicted for, the founders were indicted for embezzling money.
Was that a Brad Feld company?
That was a big lesson. Actually, that wasn't the first one. The first one was a company out of Seattle that I think is still alive at the moment. Oh, look at these motherfuckers up front.
Any guys,
Serious?
questions? Any questions for Dave or I? It's okay. If not, we'll just keep talking. Yes.
How much due diligence do you guys do? It sounds like it's 30.
None whatsoever. How much due diligence?
Great question.
You want to talk about the cab ride company, Baden? All right, let's talk about that. Oh yes, awesome. We're both investors in Baden.
I've hedged it by being an investor in Limos.com, which just raised $10 million from Austin Ventures. After Bill Gurley from Benchmark looked at it pass and invested in Uber cab, motherfucker.
Do you see these?
So these people, the due diligence. It's a great question, but here's the answer on due diligence. Due diligence is super, super important. Obviously, my due diligence comes from me going through a pattern, just like Tiger Woods plays golf. Routine matters. My due diligence comes from 10 years of looking at the market a certain way, following trends, okay, looking in hundreds of entrepreneurs' eyes, and really being wrong a lot. And that's what we don't talk about a lot, is all the failures that I have from Cars Direct, which I invested at a $600 million valuation in a private market with negative gross margins. So doing due diligence obviously matters. But at the same time, I like to pick industries that have been invested at least once or twice by venture capitalists, because those people truly do their due diligence, even though they look dumb sometimes. That is their job, trust me, to do lots and lots of due diligence. So as small investors, as angel investors, as entrepreneurs, you want to hunt where there are fish. You want to fish where fish are. So our due diligence is to find places that venture capitalists are spending money. Where we're going to win as small companies and where we're going to win as small investors is by out-hustling, out-marketing, outsmarting, and focusing our time and our energy, and we know who to target. So due diligence is in the eye of the beholder.
Actually, I like that last part. Due diligence is the eye of the beholder. So at least from my process, a lot of times the first check is my due diligence. I try and do some basic filtering, both on people and business, and kind of a little bit around customers. But usually that process is fairly quick. So the example that someone was talking about, the company I funded in a cab, although they were picking me up because my car was in the shop, and I tweeted out I'd listened to a pitch from somebody who gave me a ride. So that company was working on a product area that I was interested in, messaging and communications. They were a Techstars company. They were referred to me by a larger VC. The basic idea was applying game mechanics to making email more productive. And I'm pretty sure people at some point will pay for some form of that product. So for me, it fit a pretty basic filter. And I think the founder actually has a MIT background, I'm not sure. But yeah, it shows you how much due diligence I have. I can't remember the guy. But after that first check is written, whether the business is being successful or not is determining whether we're going to follow on invest. So a lot of times I'm really trying to understand, by giving them a small amount of money, what they do with it, more than the traditional process, which is you go have 3-5 meetings with a person, do maybe 20 to 30 hours worth of research, and I still don't think you have a good read on the company. So I actually think sometimes it's larger VCs who have a traditional due diligence process who actually are not doing very much diligence before they write $1 million check.
And let's define venture capital. I mean, if Kleiner's doing $300 million at a $4 billion valuation, that's not venture capital. To me,
that's late stage mezzanine.
Yeah. So I mean, venture capitalists, it's just words thrown around right now. I mean, venture capitalists in the eye of the beholder too. I mean, it's all about risk and return and money management and risk management.
So I think that the bigger sort of difference is, are you an investor who's investing after traction or before traction? And that's probably the big difference. So one of the things that we are trying to do is invest before there is obvious traction, at least to other investors, and have some interesting intuition or metrics that give us a reason to think that there will be traction. So we're generally investing before when prices are lower and doubling down after, rather than most VCs who are waiting for traction and then they have to compete for the deal, probably pay higher prices, but there's greater likelihood of further success.
And the other thing about due diligence is, again, being in the eye of the beholder, my due diligence is risk management. If a deal comes to me that's over a $3 million pre, they're already priced out of my due diligence where I won't even look at it because I have rules that I live by. And whether you're trading or investing in startups or being an entrepreneur, you have to set rules and boundaries for what you're willing to do. Every bad deal I've done was dead before I started it because I didn't add a value. And even though it might have been a great deal, I didn't know the industry. I had no passion about the industry. So part of my due diligence personally is kind of the hit by bust test. If I couldn't be head of sales or marketing of a company that I invest in, then it's probably not an investment that I want to make. And that's a layer of due diligence.
Okay, Fred's at the mic. Hit it.
Dave,
Fred.
I love your model, but averaging your ownership up in companies that do well is hard. So
Averaging ownership up in companies that do well is hard. I would agree. I have to be really fucking awesome, and I have to be value added. I can't just write a check and get that opportunity. Sorry, did you have other points in that question, or was that? Yeah, so it's a fair point. Typical model for most investors is aim for investing at 20 to 40%. Hang on and invest to maintain ownership if you think it's working. Our model is more like invest between 1 to 5% at each round and try and invest more in the future, even super pro rata if possible when we think it's working. We might not always get that opportunity, but I don't know. Actually, what's kind of emerged is most people I've invested in I have a very personal relationship with, even if we don't spend as much time maybe as a typical investor who's a board member, and we've gotten that opportunity in a lot of them. Don't be an asshole is important to getting that opportunity.
Yeah.
Go ahead, go for it. What should an entrepreneur reject in a term sheet?
Read Brad Feld's blog. I'm not very good at the legal stuff, so it's a great question. That is not something that I should answer for you properly, but what you should reject, you've got to, a lot of people do the due diligence for social proof on who their investors are. The smart thing, a great opening question to somebody that you trust in the venture or angel businesses, who's the lawyer that you use in New York, San Francisco, or LA? And I would get yourself, a lot of these great lawyers that do startups will do a lot of work for free early if they think your idea is great. But don't worry about your lawyer about whether the idea is good. Ask a great attorney for that stuff.
I think the simple answer is you want as clean a term sheet as possible, but I think you're missing the more interesting question, which is how do you get multiple potential investors in your deal? Right, because your ability to negotiate away terms that you don't like is going to be based on whether you're oversubscribed or not. And so, do you want to talk about AngelList maybe? Because I think that's an interesting topic that's going on in the industry. So really quickly, try and basically raise an amount of money that's less than you think you're going to have investor interest for. Initially get a partial amount of money raised and then try and work up to a lead investor and then work your way back down to fill out the rest of the round. Your ability to negotiate away terms you don't like will be highly based on how oversubscribed you are, and you can do it if you are oversubscribed. In general, you can't if you're not. How many people know about AngelList? Raise your hand. How many people have listed on AngelList?
How many people like AngelList, just in general, as a learning tool?
Yeah.
I think people misunderstand the product. Do you like the product?
I like the product a lot. I think generally it's extremely helpful for entrepreneurs, and it's largely helpful for investors.
I've invested in 4 deals from AngelList. So I think it's again, I'm looking for speed and acceleration, and I'm looking for curation, which is sometimes an underused word and sometimes an overused word. It just depends on the context. But I like the curation. I think it could get better. I think they're going to have problems, because there's intent issues. But again, AngelList is something that you should really start to understand.
Particularly for entrepreneurs and investors who are not in more active markets like Silicon Valley, New York, I think AngelList is a great way to get in front of other angel investors and find out what deals are actually happening. So it's great visibility into the market.
Any other questions?
Yeah, so in terms of structure at early stage, how are you guys doing deals? Is it convertible debt, preferred, commons? What's kind of the...
So the question was, what's the structure of the deals that we do? For me, the answer is probably 2/3 convertible debt, 1/3 priced. We are usually not leading on price deals, but we're happy to do them. We are occasionally the first check, actually probably at least 1/3 of the time, maybe even half of the time. We are helping put together very simple convertible note structure deals. Usually those have a cap on them. Usually they have some form of discount on them. One thing that I am starting to recommend to entrepreneurs, a little bit more advanced kind of thinking here, but if you want to raise X million dollars at Y valuation, try and raise X over 2 at Y minus and raise X over 2 at Y plus, which basically means take the amount of money that you're thinking about raising, break it into 2 chunks, and offer a better priced deal for the first chunk to the investors that jump in. That creates perceived value and scarcity. I would offer that deal to the investors that you think are likely more interesting and reward them with a lower price. The danger of that deal is you might have to offer the deal to everyone at that price, but if you are oversubscribed, you can get a certain amount of money at that lower valuation, smaller amount, get some capital in your pocket to take the product further down the road or get more customers, and then probably do a second part of that deal within a short period of time after it if you are able to get any progress in the product.
For me, and again, I invest between 50 and 250 and around, is I rarely, once a year I'll lead a deal where even though I can't put up the lead money, I'll bring a group in of friends and family and people that I've done deals with before, where I act as the lead because I act as the leader of the group, even though I may not be the smartest. I've done this and I bring people that want to invest with me in certain deals. And then I generally either like to price around at a 2 to 3 million valuation, or I put a cap on a convertible. I don't mind doing a convertible as long as there's a $3 to $5 million cap on it. And like anything, rules are meant to be broken, but I generally try and keep very tight to those rules.
On the price rounds, are you doing what?
I've never done a common...
Most always well, I shouldn't say that. Our accelerator program we do on a common stock structure, but typical seed investments we do on a preferred round structure.
Yeah, I don't do common. I do common, if I want common, I buy Lululemon and Open Table.
Any downsides to being oversubscribed?
And downsides to be oversubscribed, pissing off people who you want to get in the deal. Not usually. Yeah.
It's all about
any downsides to being hot sexy? I don't know.
Yeah, it's about style. It's up to the CEO. If they're good enough, if the product's good enough to get oversubscribed, it's up to the CEO to show some style. And you can tell a lot about a management group when they are oversubscribed. A lot less. You can tell a lot more about your entrepreneur if the deal's oversubscribed than struggling to raise money. So I think it's you got to be really careful when you're oversubscribed in talking to your investors.
All right, we're getting the hook.